over a summary of what we did last time. And we're probably going to do that each time because that really is all of accounting, okay? So let's start with the income statement. What is the income statement in terms of what goes on the income statement? We have revenues minus expenses, okay? So we'll just write this right here. And by the way, you're going to see why I use this side of the board instead of that one right first. We're going to use revenues minus expenses. And I'm not going to write profit because I want to focus more on what we have. Now, last time we talked about a balance sheet. What is the balance sheet? This is the biggest thing you really need to know that's going to help you a lot. What is the balance sheet in terms of what type of accounts on there? What type of equation do we have on a balance sheet? We have what?
Assets.
Assets. Yes, sir. Assets.
Liabilities plus equity.
All right, so we have assets. We have liabilities. And we have equity. And I believe you said plus equity, right?
Yes, sir.
All right. Plus equity. And this does what? It equals. Now, why is it important that we talk about the fact that it equals? Because remember, if you want to invest in the business, if we want to invest in that restaurant or that gym or anything else that we have, we want to make sure that we buy things that we need, right? And we're going to pay for them either using cash or let's not say cash. We're going to use it, pay for them outright, which means we'll have 100% equity in it, or we're going to borrow some money and then we'll be able to have a little bit of liabilities. That's not something we actually want, but we will have liabilities at that time. So anything that we buy that's an asset, we're going to pay for it or finance it using a liability or pretty much our own stuff. Does that make sense? Okay. Now, we're just going to use one small example. Let's just say that we have some cash, because we agree that cash is an asset, right? And since we're talking about it, let's list the current assets. You remember the current assets last time? What's that abbreviation that we use to make sure we always know what they are and put them in order? What's that abbreviation we use? Crisp. They got to be crispy, right? So we have cash, then we have what? Accounts receivable. I put that there because it kind of goes with it, but of course the accounts receivable part goes out here. We have what? Inventory. What else? Supplies. And what else? Say again, prepaid. And of course, the debt investment, I'll say with the D, but obviously it doesn't go with it, but I want to make sure that we understand that debt investments is there as well, but it goes right there, okay? So that is what we have in terms of our current assets. Current assets are always listed in order of liquidity. What does that mean? It means it's listed in the order in which things can turn to cash. Cash is cash, so it's not going to turn to it, right? Then we use example if I owe you some money versus if you own all these supplies. You can probably get the money from me quicker than you can get it from someone else on the supplies, right? And so we can turn that receivable, what you expect to receive from me, into cash a lot quicker. So that's why we go, of course, inventory is easier, supplies, because I can probably sell inventory if I had a store quicker than I can find somebody to buy my computer. Okay? And then prepaid, that means you paid up something in advance. Something we'll get to a little bit later on. Current assets must always be in order of liquidity, in this order, okay? And of course, later on we have equipment and patents and copyright and stuff like that. Now, with our liabilities, that is, we're going to use it's not the official definition, but basically it's in general, liabilities are what we owe. That's that long-term thing that we have bought and we're going to pay for that over time. And then equity consists of stock and stuff like that. Everybody good? Now, we're going to take this section here, cash. Let's just put it over here. And we know that cash is an asset. But does that tell us that we have more or less of cash? Doesn't tell us anything, right? In order to do that, we must debit or credit that. The word debit simply means left, and I know it's a little bit different. The word debit simply means left, and the word credit simply means right. That's all it means, correct? So, in order for us to say that we are increasing our cash, let's say that we start off with $0. So there's nothing obviously there to put a zero. If we want to increase the amount of cash we have in there, would I show an increase by putting it on the left side, debit, or the right side, credit? Left side? Right side? So the left side wins, that's correct. Okay, so I increase with a debit. Okay? Which obviously we know we're going to decrease, but our goal is to make this really simple. We want to understand what goes where. So the more cash I have, when I sell that inventory, I'm going to have more cash, right? So I'm going to increase my cash with the what? A debit, okay? When I sell, if I go out of business, sell my supplies, I'm going to get some cash. I'm going to increase it with a what? A debit. So anytime we increase cash, we do it with a debit. Why is that? Why do we increase cash with a debit? Because it is a what? An asset. And we increase all assets with a debit, right? So if we want to show that our assets are going up, let's just say we buy some equipment on credit. Don't worry about the on credit part. The thing is we've increased our equipment, right? So how do we show an increase in equipment? It is an asset. So if we were writing that down, we would put a debit or a credit for equipment. Equipment is an asset, right? And we increase our assets with the what? With a debit. So anything we increase with an asset is going to be increased with a debit. Everybody good? So yes, ma'am.
I know that it doesn't necessarily have anything to do with debit or credit cards in the bank, but could you technically also think of it that way as like what goes into your debit card is what you earned versus what goes into a credit card is what you're borrowing?
I wish I could say yes, but the thing is, and basically the question is similar to how do we treat banks and credit cards. When we talk about banks, remember that they are usually doing, just in general now, they're doing the opposite of what we do in terms of accounting. So in general, they have a totally different way of doing things, and it's a good thing to be able to talk about, but when we're trying to do it in accounting, it's going to throw us off a little bit. For example, they credited my account. What does that mean? You know, in accounting terms, if you credit something, you're receiving this cash back over here. But in a statement, you may see a little bit different. So the thing is that with banks, when you take if you were in accounting or whatever, if you take a financial statement analysis class, you're going to have most of the book is going to be on accounting, and then you're going to have a different section that deals with banks and everything. So that's going to be a little bit different question than we have here. But it's good to ask those questions because you're related to stuff. Anytime you start related to stuff, you can now make a decision. This is what I saw over here. This is what I see. Why is this correct? So that goes for anyone. As you think about these things, I hate to say start thinking about stuff, but as you pay your bills, think about you reducing your what? Your liabilities. Speaking of which, if we increase our assets with the debit, any assets increase with the debit, right? So how do we show an increase in liabilities? Keep it in mind this. Here's an equal sign. If I'm saying in the middle of the equal sign, if I raise my hand up over here on one side, then I have to raise my hand up here to be equal on the other side. So we take this same concept over here, and we show on this side of the equal sign that assets increase on the left side. So anything on this side over here increases on which side? The credit side, right? So good. So liabilities will increase with on the credit side. And the same thing for equity, right? Because it is on this side of the equal sign, correct? So they increase with the credit as well. Okay? We're not worried about the debit, we're not worried about the decrease, because obviously the decrease is there's only one other choice. But I do want to make sure that we understand just this basic thing. This is going to take us from chapter 1 through chapter 3, and as you're seeing, it's basically all just one thing. Okay? Yes, ma'am.
So with this, it will technically always, in terms of which side it goes on, it will always be positive. If the assets is the credit, liabilities and equity will always be debit, or should.
Okay, so what you're saying is if the assets are a debit or a credit in this case, then in order for it to be equal, yes, the liability will be a debit.
And it'll always be a plus. It's never going to be like a minus.
On the liabilities? Yeah. I think let me ask you this question. Are you saying what balance will always be in here?
I was thinking that the debit was positive and the credit was negative.
Good point. Let me do this right fast. Debit does not mean increase or decrease. Credit does not mean increase or decrease. That's simply talking about which side it's on. And this is a good question because these are chapter 3 questions that, you know, if you're doing chapter 3 right now, you know in a second when we do some chapter 2 problems, they're going to be fairly easy, right? Because all I'm going to tell you right now for chapter 2 is you basically have to do this section plus the rest of it. So it's good you ask these questions. No, debit only means left, credit only means right. It's what's associated with it is going to matter. It's just like a note on a piano. A note is a note, right? Now, you play that note, it means nothing until you put it in a certain style of a song. That's what makes the style, you know, how you do it with other stuff, but a note is just a note. A debit is just a debit. It only depends on which side, the equal side we're on. And that's a good point because if we just get it stuck in our heads, which I did it, you know, I used to do it. Debit means increase, no, it means simply left or right. And the character of what it is, asset or anything on this side, is going to tell me that debits increase over here, and over here they decrease. To give you a small example, this is not right. This is chapter 4, but this is a good question. I want to show this to you. If your liability decrease, if I debit a liability, that means decrease, right? So if I pay off part of my liabilities, then wouldn't it make sense that I would use cash and credit that to pay it off? Wouldn't it make sense? Once again, showing it is equal. That's one good thing about this. Technically, you can always check your work because there should never be a time when your debits or credits are not equal. This is going to become a lot clearer a lot later on, but these are still good ways to think because you're already thinking ahead, okay? So actually keep those questions coming. Any questions so far over here? Everybody good? All right, so one more time, just to go through it. Assets equal what? Liabilities plus equity. Assets are always listed in order of what? Liquidity, which is going to be given in terms of what's our abbreviation? CRISP. Cash, then receivables, inventory, supplies, and prepaid. The rest of them, technically there's not an order like that. You may kind of get used to it, or your textbook, or your to send in the textbook a certain way, but there's not an order like this because we're not worried about liquidity. They are all long term at that point, which means that we're not trying to turn them into cash right now. So that's the reason why. And then over here, we'll have our liabilities, which we will split up again to current and non-current, but don't worry about that. We'll kind of go through an example in just a second. But that's why we have that right there. Any more questions on that? And if they'll come up later, that's fine as well. But everybody good with their review so far? And we're going to try to do that pretty much every class, okay? That's first, definitely. Now we're going to get ready to go to the next section. All right. When we get to chapter 2, one of the big things we're going to be concerned with chapter 2 is how to present a balance sheet. Why is it important to present a balance sheet? Remember, the balance sheet is a picture of something at one point in time, right? But the income statement is over a period of time. What the balance sheet is going to show me is how my assets are. What percentage of assets do I have? This is one of the things we can talk about with that, okay? I have my assets. I have a car, and I bought that car either on credit or I have 100% equity in it. So the assets equal liabilities plus equity. It's simply showing me what percentage of stuff that I have there. Now, within each of those, I need to know where they go. So what you'll see in exercise 2.7 is you will see a bunch of accounts. A bunch of different accounts. An account is something that you actually have something and you take what you have and put it in an accounting form. That's all an account is, okay? So in this section here, we see the following accounts. We see common stock, prepaid rent, and as a matter of fact, you don't have to know this yet, but just for practice, when I call them out, tell me where you think they go, okay? Because that's what we're going to do in just a second. Common stock, is it an asset, liability, or equity account? All right. Prepaid rent. Asset. Equipment. Stock investments. Stock investments, these are long-term investments. So let's just start right there. Stock investments, long-term stock investments. It goes on, and let me help you out again. Compare those with debt investments. Debt investments are short-term. Stock investments are long-term. What's the difference? Debt investments, as we know, that goes now crisp, right? And the long-term investments will go down here with equipment and patents and stuff. Now, this is just a thing we have to worry about in here. The reason they're talking about debt, stock investments being long-term is this right here. You can buy some stock. And by the way, what does stock mean? The word stock is simply talking about ownership. So when you buy stock, you're just gaining ownership in what you have. That's all it really is, okay? With that in mind, we know that we're not really trying to own stuff. A lot of times we just want to make money off of it, just to tell you the truth. So if you see that a certain product is going up and you want to cash in when it goes up, it's okay to do that. Just understand this here. If you cash in less than a year, then your taxes are going to be a lot higher than if you wait till longer than a year. Does that make sense? So I'm not telling you have to hold it a long time. You know, it's January. If you get something right now that cashes in for $10,000, can anybody use $10,000 right now? Would you probably cash it in? I know we're going to pay a little bit more taxes, so I'm just saying, let's say we have to pay $3,000 instead of $1,500. You got something you can do with the $7,000, right? And I'm not trying to encourage you. The point is, just make sure that you understand which way you're going. You're going to pay more tax. I don't know what tax brackets. I'm just kind of just making up different stuff. The thing is that, look, you're going to pay more taxes in the short term than if you wait for the long term. Now, if it's the last day of the year, I might just go ahead and let it roll over because I can't use that within this one day. Does that make sense? So that's just a tax. That's not something I have a test on, but just remember that if you're doing your little cash accounts and your little stock investments, just make sure that we know that if it's near the end of holding it for a year, not the year, but holding it for a year, a particular time, that we may as well just go ahead and hold it to the next day unless we have some dire need for it right then, okay? So that's those two. We'll come back to it. Income taxes payable. Is that an asset, liability, or equity type of account? Liability, good. Cash, we know that, right? Asset. What about accumulated depreciation? I'm not going to ask you what type of account it is, but I'm going to ask you which one does it go under. I'll come back to that one in a second. We'll talk about that. What about accounts payable? And you know whenever you see payable, that's going to be some type of liability, right? That's just kind of a giveaway. Patents. A patent is an intangible asset. Where does that go? Huh? Assets. Why is that? A patent is an asset. An asset is something you can probably, a part of the formal definition is an asset has a probable future economic gain. Probable future economic gain. Remember, inventory is an asset, right? If you have the inventory on hand and it gets destroyed, you're not going to make an economic gain off that, right? Now, chances are it won't happen, but that's why the word probable is there. A probable future economic gain. So, a patent, a probable future economic gain, right? If you have a patent on something, that means you have ownership of it. You own it. You can make money. Only you can make money off that for right now. So, obviously, if something goes wrong, a better product comes out, it won't make as much money. But the thing is that that patent is going to make you some money because you're the only person that can sell it at that point in time, or you have the rights of that. So that's, if it kind of helps you to remember why it's an asset. An asset is, generally speaking, just a part of the definition, a probable future economic gain, okay? And most of the time we're going to make is just you have to put probable because that's the correct thing to do, to let people know that it's not 100%. Does that make sense? Okay. What about notes payable? Good. What about retained earnings? That's okay. That's what equity. Good job. Now, how do we know that? Earlier we talked about our income statement, right? And our income statement has to do with revenues minus expenses. Now we can say that equals what? A profit of some sort, okay? Now, I had some in year one, right? I didn't spend it. So instead of spending it, I did what? I retained that profit in the business. Every time I retain profit in the business, that goes under this section here, equity section, okay? So retained earnings is earnings that we don't use for other purposes, but we retain it in the business. I'm going to give you a little quick note, and this is going to be for later, but it's important as well. We talk about revenues minus expenses equals profit, and we retain it in the business. We know that companies pay dividends, right? And we want dividends. That's no problem. We want to understand how it works. You do not, a company does not pay dividends out of the income, okay? It only pays them out of retained earnings. Why is that? Your income statement, we talk about stuff over a period of time, right? Well, Payments that are dividends have to do with ownership type of stuff. The income statement is more so concerned with what we do with our business, right? Think of it like this right here. And this is going to be a chapter 5 concept, but it applies here. This school actually has an athletic department, right? They make money off athletics, right? So imagine you own the school. It's not a non-profit. Let's imagine you own the school. It was business. Your business is in the business of education, right? So you need to know how many students are coming in, right? Because that's what you're bidding for. You got the best football team in the world. If you don't have a student body, you probably don't have enough people play football just to start with, and then it's going to be totally separate. So technically speaking, you can make money off your football team more than you can make off of your tuition, right? But then let's say you have a down year in football, but your education, your tuition is constant. You want to know how much money your business makes. So you always put in the income statement what the business is designed for. It's great if you make that. It's great if you personally speaking now, if you invest some money and you make double your salary this year, can you depend on that for next year? Can you depend on the fact that your investment is going to make that much next year? Can we do that? No. So that won't be in our income statement. That would be what you call other income. So the reason I'm bringing it up is because when we talk about paying dividends, dividends is not depending on what you did in your business. It's coming out of your retained earnings that you have over time. That's going to come up later on, but just put a star that dividends are only paid out of retained earnings. Dividends are only paid out of retained earnings. Dividends are not paid out of the income statement. Even though you keep on just putting income or profit into the retained earnings, you don't pay it out of there. You don't pay it out of here. You pay it out of your retained earnings. Okay? So dividends are paid out of what? Retained earnings. Good job. And of course, accounts receivables, and then we have what? Inventory, and we know where those go. Now, what is our task? Our task here is to prepare a balance sheet. This here is called a classified balance sheet, okay? Classified balance sheet is this style right here. We could just say all assets minus all liabilities is going to equal equity, but we can get a little bit more out of it in terms of how we can do different analysis by putting it in this form. So when you're asked to prepare a balance sheet, or when you're looking at a balance sheet, you want to see if it's in good form, meaning that it's in this style right here. When we talk about current assets, we're always going to start with our balance sheet with current assets, okay? Our balance sheet is always going to start with current assets. So this is our skeleton, right? We're not worried about debits and credits in this chapter, but that's one thing to help us tie everything together, okay? Yes.
There's nothing on the screen.
What happened?
There's nothing on the screen.
Oh, there's nothing on the screen. That's exactly right. Thank you, sir.
I didn't know if it was intended.
Oh, no, that's fine. No, you're exactly right. There's nothing on the screen. Let me put that up there for you. That way, of course, if we don't have the books, keep in mind that these numbers are going to be a little bit different, okay? These numbers are going to be a little bit different. So keep in mind the numbers are going to be a little bit different in yours, okay? Now, your current assets are what? We're going to start with current assets. We're always going to have current assets first. We're always going to have order to what we do. So current assets are going to be first. You good on that so far? Now, if you have something that's current, you also have something that is what? If you have something current, you're always going to have something that's what? Long term, not current, long term. So we call our non-current or long-term assets down here. Okay? Don't worry about filling it in yet. I mean, obviously, if you can go ahead and fill it in, I would encourage you to fill it in. Just come back and check it by our answers, okay? Now, assets, all of these assets are paid for using either a what? A what? A liability or a some of your equity, okay? Now, current assets, if we have current assets, when it comes to liabilities, we also have two types of liabilities. What are the two major categories of liabilities? Current liabilities and what? That's correct. Current and non-current. So what we're doing is we started with a skeleton, now we're putting on just different bones in there, and then we're going to put the meat on in just a second, okay? Or vegetables if we're not eating meat, okay? want everybody to come to the buffet, right? So we good? Now, why is this important? This is important for this reason. Current liabilities, let's just take cash by itself. Let's take cash, and let's take a non-current liability equipment. One of my current liabilities could be, this is not, well, let's use one that's not there. Could be my utilities. So I have some utilities, light, gas, and water, right? Which one of these assets do you think I'm going to use to pay my light bill? Current assets or non-current assets? Current. Why is that? Because cash is easy to get to, right? Now, only a crackhead will sell a whole house, right, to pay a little bill. So let's think of it, however this gets through, we want to make sure you understand why we're doing this. This is why we have to match this, right? We have to do this because if we don't, we're going to pull out of the wrong bucket. Now, it might be a mistake on our books as we're doing in class, right? But when you get to that job and you see somebody, you look on your book and you see all this equipment gone, and your supervisor asks you what happened, you might be accused of stealing because you made a mistake. You see what I'm saying? So just a lot of different reasons why, from an accounting standpoint, current assets are going to be paid for with current liabilities. Non-current assets, there's going to be a portion of this that's going to be paid sometime, but we're not going to get into that. The big thing is that we want to make sure that that when we're looking at current assets, these are always going to be compared to each other in a ratio we call like working capital, okay? Now there are different forms and we're not going to go into that, but just understand that this is why. It's not just about putting it on paper, but we want to understand why it's there, right? Now, understanding why it's there will help us to get the question right, but it's also going to help us to make our decisions as well, okay? And then we have, and I know we're saying two a lot of times, we're going to break this down to two as well. We have stock here, and we have retained earnings. Now, this has nothing to do with that over there. I just want us to understand that we have two categories. This is not, once again, these don't match up with these. This is just saying that we have two categories over here. So I'll just put it like that. Just to make sure that we understand this to divide. This is not necessary to do this right here, but I just want us to understand that these are related to each other. It's still on the equity side, but I just want us to understand that it's related to each other. Okay, so you don't have to draw that line. Just understand that that's why that this is why it's here. All right. We good so far? Anybody still want to open up a business? Who want to open up a business now? You still at the gym, right? My restaurant lady not here, is she? Oh, you moved. Oh, you gonna bring me some food? You move it close. Okay, keep right there. And my restaurant lady, no, my event planner. I think I saw her earlier. She'll probably be back. She'll probably plan an event. Those are three businesses. Yeah. What other type of business we gonna get now? No other business? No other business? Well, it's too much work. Not too much work. Too much of a headache sometimes, huh? You must think about business with employees. If you think about business with employees, then you're thinking about some salary payable, right? That's what you're thinking about. But what you really want to have is some equity. You don't want to pay nobody, do you? I can't blame you. If you can do it, okay? You see how we just use this to relate different stuff because it's going to help us when we get stuck. You know, you be on the exam, to a certain level. I mean, you play sports, music, whatever it is, there's always that old factor, right? But this is what you practice for, to put things in a way so that when you get to that point, then you're able to come back to your senses or come back to normal, okay? So now that we have everything, we can go ahead and we can, oh man, I gave y'all the answers. Oh, sorry about that. We can go ahead and fill this in. I hope y'all didn't see that, okay? We're gonna look at it in a second, but too bad. All right, so let's see. I'm gonna give you a second to go ahead and write in those answers, okay? When I say write in the answers, what I'm saying is with these accounts. Now, if you are using this, fine. Which you can use. I tell you what, use this, and then you have the same example in your book to go back over and have different numbers. You see what I'm saying? That way, it's like you have two different problems that you can practice. Does it help you out? Okay, so go ahead, and all I want you to do, is at the very least, just put my accounts in here. We have 6, 7, about 14 accounts. Put those 14 accounts under the correct ones. And I'm gonna just try to see if we have everything we need, okay? Oh, okay. Oh,
They're falling out.
Everybody doing good overall so far? Anybody finish the assets section? Still working on that? This is what it looks like. That's this. Like some people add some stuff up on it. All right, everybody want to give it a try? Is anybody using their own books? No, I think we said we're going to use this so you can have some practice at home, okay? So what do we have? Let's go ahead and see what we have here. What do we have? What do I put first here?
Cash.
Cash, okay? Cash. Then we have what? Is that the next one we have? So, debt investment. Only reason I bring it up is because remember now, you may have been doing it this way. You may have want to go ahead and do your crisp and then come back and put the D in. If that's perfect if you're doing it that way. If you want to go ahead first and put that debt investments in there, you still probably using the same crisp as you get it. So that's the only difference she made. I'm going to go ahead and write it in here this time, but let me make this a little bit different because I still want to emphasize that we're doing the same exact thing. You have cash, you have debt investments. Good, excellent, okay? What do we have next?
Accounts receivable.
Accounts receivable, right? Next, inventory. Everybody want to make a lot of money? All right. So y'all can let him sing the solo? If he sing the solo, he gonna get all the money. What about my choir? What's the last one we have? Yeah, we got some people singing now. Prepaid. Oh, we singing the wrong key. We have cash, we have receivables, inventory. Do we have? We don't have any supplies? Okay, we were just gonna put this in. Y'all sing the right key. That's no problem. And I'm just gonna put that there just for memory purpose, okay? Then prepaid, that's correct, okay? Everybody good with that right there? Do you see how this still can be helpful to you if you get, I say crisp with a D, just depending on where you have it, but at the very least, put this in, I think that'll be helpful for you. And that's just something that I just do, just color-wise, so we can know we're still working with the same exact thing, okay? How's everybody doing on that part? Anybody want to keep on going? I'm going to make this in a second, just get this up here. That was just something we did for a little thing. Is there anything on the non-current assets? What do we have? Equipment, that's right. We got to run our business using some equipment. What else do we have?
We have the depreciation of the equipment.
Depreciation of the equipment. I forgot again. Let me go ahead and do it. I keep saying we're talking about depreciation. Let's talk about depreciation. This is in accounting terms. This is what depreciation is not. When you go to buy your car, chances are they're going to say, when you drive off the lot, it's already done what? Depreciated. That's not what we're talking about. With depreciation, we're simply saying that, look, we're simply saying that we bought something. We brought what kind of car? What kind of car cost $50,000 that you want? Nobody want a car cost $50,000? You don't have to pay for it all at one time. So they help you out. You don't want a $50,000 car? What about a nice Nissan Titans? They don't make them no more, so you don't want that, right? I need a car that's cost $50,000.
Ford F-150.
Ford F-150. There we go. Ford F-150. It costs $50,000. Now, we can pay for that all at one time, right? And if we pay for that all at one time, when we see our income statement, it's going to be revenues minus expenses, and this will be a $50,000 expense, right? If you do that, I don't care what your income statement, well, in general, for our income statement, if we have that on there on our personal income statement, that's going to show a huge loss for that year, right? And don't get me wrong, Paying $50,000 is coming out of cash. But how do we show that we bought this for our business, this $50,000 car in our business? How do we show that? We can show that we paid all that right now. That is true. And if you pay it all right now, great. You have the option to do that. Only thing about it is, this doesn't change the money spent. It's just about over what period of time did you use that, okay? Are you gonna use that, now, it may be possible because, just different things. Did you use that, will you probably use that truck up all in 1 year? No. Let's just say that you're gonna use it for 5 years. And it could be a situation where there's some businesses where if you have your own business, you have to get a new vehicle every 3 or 5 years because they need to make sure that you can do what you're doing. So it may be that business that you have. And if you use it for 5 years, remember the income statement shows what you did for that period of time, right? If you use it for 5 years, wouldn't it be more appropriate to allocate the cost of that truck over that 5 years? Who agrees? Okay, so how do we do that? We do that by a methodology called depreciation. So every year, I'm going to have some depreciation expense for $10,000. Depreciation expense, $10,000 every year. Keep in mind, this is depreciation expense in my income statement, okay? So my income statement has depreciation expense of $10,000. Everybody good so far? Everybody good? Now, in year one, my depreciation expense is how much? $10,000. So my accumulated depreciation expense, my accumulated depreciation, not depreciation expense, my accumulated depreciation is $10,000 and my expense is $10,000 in that first year. We good? In year two, what is my depreciation expense? $10,000. What about year three? The expense is what? And year four and year five. But my accumulated depreciation each year accumulates with what I've had, right? That is the accumulated depreciation. That's how we get to that. So you may want to put a star at the bottom of your page. Depreciation expense is income statement. Remember, income minus expenses, okay? Accumulated depreciation is always shown as a reduction of your equipment. Take a second to make sure that you have that there.
Can you say that again?
Okay, depreciation expense is always an income statement item. Remember, we bought this here. We could have shown that we put all $50,000 in year one. It is nothing wrong with that. But a better way is to show that we use it. We use it over the same period of time. Let's just say this way: what if we could have bought a part of the truck in 5 equal payments over the year, or over the 5 years? That's another way of doing it. Okay. The depreciation expense is an income statement thing like salary expense, utility expense, general administrative expense. All these expenses, that is just a depreciation expense. But when we add it up each year, that is an accumulation of the depreciation expense that we have. So accumulated expense for year 3 would be how much here? 10 plus 10 plus 10 give me what? Depreciation, accumulated depreciation at the end of 5 years would be what? 50,000. Accumulated depreciation for year 1 would be how much? Huh? 10. Okay. Does that help you out there a little bit? Does that help you out there, ma'am?
Yes.
Okay. All right. So back to what we said, accumulated depreciation will fall under the asset category, looking at it as less accumulated depreciation, okay? Less accumulated depreciation, not depreciation expense, because depreciation expense is a what type of item? Income statement, equity type of item. Okay. Can you see everything there?
Oh, yeah.
Okay. Any more assets? Stock investments, long term, okay? So stock, I know we at the bottom, sorry, we can't. This stock investment is one of the non-current ones, stock investments. And it's important we understand these are long term, because remember we talked about earlier, you can sell those back, day trading, That's short term, okay? And they're just, all they're saying is that you pay a higher tax usually with your regular tax than you would for if you hold it for more than a year. That's the reason I brought that to our attention earlier, okay? Anything else we have? Patents, right. Why is patent an asset? What we talk about with a patent, you have the ability to do what? Well, not to sell it, but to sell off of that or to make money off of that. But it is probable, we don't know if it's going to last, but a patent is a probable future, a patent has a probable future economic benefit, okay? So that's why we put it under assets. You'll never see a patent, but if you have a patent, obviously you can look at the paperwork, but a patent or a copyright or a trademark, those are not tangible things, okay? So that's what they call intangible assets. But having an intangible asset gives you the ability to possibly make money in the future, all right? Everybody still good? Any more assets we have over here? You want to add those up? Add up your non-current assets, and then add up your total assets, and let me know what you get. And we'll look and see what that answer is. We'll take 3 answers. We'll see if we'll have 3 answers that are the same before we pull it up. Can you see how this might be helpful in your major a little bit? If not, that's fine. It's only, what, the second day, but anybody, just kind of give me a little hand or something, whatever. Okay, all right. And like I say, in your major, what you're going to have to do is, this is about the extent of what you need to know for your major, if you're not an accountant. The reason I say this is because obviously there's going to be numbers attached to it, but you need to be able to show the people that I understand that I'm not just asking for this car. I'm trying to have make an economic gain. And I know it's probable, but it's highly, but you can even say, if it comes down to 2, I'd rather have this one because it's more likely I can make money for the company off this one right here, okay? And when I do it, it's going to pay for itself, or it will at the very least help us to keep the company afloat, because I know make a lot of quick cash, relatively speaking, quick cash with it that's going to pay my current liabilities. And that's one way we can look at it. Our long-term liabilities are going to be other stuff. If you're going, let's say, go like physical therapy or something, whatever. This equipment out here for physical therapy, all this is non-current equipment, right? They're going to generate some cash that's going to pay this, but the thing is that you still have to have cash or one of these current assets to match up right here. Yes, all of this, the patent that you have on this new device that you have at the rehab therapy, yeah, you're going to have that. It's going to make money, but it's not going to make money probably enough right now until a certain time, okay? Let me know when I get 3 answers. If I get 2 of them the same first, we'll keep going.
You're trying to figure out current and non-current?
Ma'am?
You're trying to figure out current and non-current?
Give me the non-current first. Excuse me, the current first. What do we got for current assets first? Okay.
Your numbers?
No problem, sir.
Your numbers?
If you want to use these, I would probably say use these and then use your book. Same exercise in your book later on for practice or whatever. But yeah, we can use if you're using this one right here, definitely. Go ahead and give me that one there.
5,940.
5,940. Anybody have anything the same? We'll go with it. Let's see what we have. Pretty sure that's right. I'm not gonna be able to scroll it over. It would not scroll over. 5,904. Let's do it this way. Let's add it up. $5,904. That's what we have. Excellent. So that means I have $5,940. Let's just kind of just think about using it once again now. If I have, and we're just gonna go down to the penny now. So we're gonna make like this. Yes, ma'am.
Should we not include the prepaid? On here it says prepaid rent for $164. Should we not include that?
Prepaid rent should be a part of that, okay? Do we have that there? Yes. I have $150 for my prepaid rent.
I was looking on I might be on the wrong thing.
No, you may be on the right one. If you're using the one in your book, that may be a little bit different.
Yeah, I'm on a different one, so my
Okay.
numbers are different, that's why I couldn't get.
That's no problem. See, at least now you have two different sets to go by, so that's good. You can have, one that you never seen to practice when you get home, and then compare to this. So yeah, but that's good though. Prepaid rent is right here, and now we know we have everything. Excellent, okay. We're gonna go to the number, because we just wanna make the point, okay? Because let's just say, like, literally, if you don't pay your bills, you're going out of business. Let's combine this and just say that all of this is inventory, $5,904 of inventory, right? Let's say that's the only thing we have. Matter of fact, I think that's even better. If we owe our suppliers $6,000, do we have enough to cover that? No. So that's what we call a current ratio. That's not something we're gonna, we're talking about in terms of for today, but that's the importance of having this up here. Even if I owe $6,000, like I say, I can't sell this computer, I can't sell my physical therapy, I can't go sell a table at a restaurant. Like, I can't sell that by 5 o'clock today. Okay, so that's why we have to have enough. Now, I use that, I know it's really close, only off by $60, and I'm not saying it has to be a one-to-one. Every industry is going to have its own standard, okay? So keep that in mind. And even every business, when you start, it's going to be a different criteria. But understand what the current ratio is in your business. I had wanted to open a gym at one time, so I didn't know what to do. So what did I do? I went online, and I just got financial statements of publicly traded gyms. I think they had Lifetime Fitness, Curves for Women, and some other one. What's the pink one right here? Planet Fitness. And I got the information. Now, each one of them had different ones. Now, each one of them had ratios that were different, but it gave me an idea of where to start. So why I tell you that this is why we're doing it. Keep that in mind, because once again, when you have to justify why you get that equipment, because what I'm asking for is a long-term or non-current. If it's non-current, show me how it's going to turn in cash to get this right here. Because that's going to always be helpful. And I'm telling you, that's going to help you in your, as you think about, if you want to think about the managerial role, because sometimes managerial roles are not all that. Sometimes you can actually make more money not being a manager. So, those are decisions you have to make, but if that's your desire, then that's a reason that'll help you out. Okay? Everybody still good? All right, so our total assets is going to be how much now? All of our assets together is going to be how much?
11,980.
11,980. They will not give it to me. I may not be able to, if I can't see it, I can't get that one for you. 11,980. Let's see if I can get that there. So, if you don't mind, give me my long-term investments number.
Your long term?
Yes, sir. You got 640? Okay, I'll tell you what. This is what we'll do. I'm gonna use your two numbers here. Let's start here. We have total current assets. We agree we have current assets of 5940, right? What's the next item you have that you have?
Stock investments.
You have stock investments as well?
For non-current, I
Uh-huh.
have equipment for first.
Oh no, I'm sorry. It's okay in terms of which one we put first. We want to see if we have those. Do you happen to have them? Okay, so we're going to check stock investments off. Okay, how much is that for? $700. That's what you have said. Same 700. What do you have next?
I have equipment for 6,070.
6,070 minus
The depreciation of equipment, which is 2,890.
2,890. Is that what you have as well? What's the next one that you have?
The patents.
Patents is going to be how much?
I don't have the numbers right now.
Oh, okay.
2160.
2160. Everybody, anyone have that patent there? Okay. What else do we have?
That's it.
Okay. Hey, y'all sound like y'all at a stockholders meeting, man. That sounds good. That sounds real good. So this is what we have. Now, even though I can't see this number here, how will I know this is right? Now, that's not saying anything, but I'm saying, if you're on an exam, How will I know this is right?
If it's equal to your liabilities plus your
If
equity.
it's equal to my liabilities plus my equity. That's the beautiful thing about this. We can always check at the very least to see now. We might not know where we're wrong. Chances are we're not going to ever be wrong right here because this is just too easy, right? But we can always check and see by going here and seeing what we have here. Tell me what your current assets, what do your current assets look like? Is this what we have? Let me go through the section here. For the sake of time, is this what we have for our current liabilities? I don't have a number to add there, but is that what we have for our current liabilities? Accounts payable and income taxes payable? Everybody, okay. Now, let me ask you a question. The year just passed, 2024, right? When are you going to pay your income taxes? When? What year are you going to pay? You actually going to, well, let's say that you owe money, okay? And I'm going to get that in a second. Let's say that you owe. When will you pay that? Will you pay that in 2024 or 2025? 25. So it is happening next year, right? You know, is that a current liability or a non-current liability? Let me help you out. Now that would be a trick question, okay? Here's the thing about it. A lot of times we say, you know, you ask your friend, oh, anybody, you owe taxes this year? Did you get something back? Anybody ever have heard those conversations before? Do you owe? Think of it this way. If you knew exactly what you were going to make in a year, you could actually go to the tax rate, to the tax column, and figure out exactly what it is and pay that. Period. You pay that, and then say you never get sick. You never have no deductions. Let me say this. Let's say you never get sick. You never have any hospital bills. You never have any child care bills. You don't have anything goes wrong. You don't give anything to charitable organizations, whatever. You could know for a fact that your taxes, whatever you saw in that thing, right? But these things happen. Maybe we work more overtime, right? That's more taxes to pay. So when we say that we're paying this year, I'm trying to make you feel better, but it is true. Don't get upset if you owe the money. Just think of it that, look, if I could have guessed last year, then I would have paid it last year. Now, on the other hand, you can get a refund, right? Trust me, they're not doing you no favor. They don't feel sorry. They don't like you by giving you a refund. It just means you overpaid. And some people would rather be in that position to overpay and get something back. It makes you feel a little bit better, but it's just a matter of I could not predict how much I was going to pay. That's why I asked that question. Is that a long term or a short term? It's a short term. Even though we go from year to year, a full calendar year has not passed. You see what I'm saying? We talk about those stock investments. It doesn't matter when I say own for a year, I'm not talking about own until December 31st. You could have bought it September the 29th. It's till next September the 29th that we're talking about. So this is why income taxes payable is a current liability, because it's talking about what just happened within that year. Does that make sense to you? So it's not, I know we feel bad when we have to pay a little bit more, but we just couldn't guess. I mean, everybody wants some overtime, right? And you're not going to turn it down. Well, I don't want to pay taxes. No, you're not going to do that. You're going to pay that taxes, and you're going to save up for it because everybody's responsible, right? So that's all. That's the reason why that won't be any type of question on your exam. But that's when we get into those trick type of questions. When a person says a trick question, a lot of times we have to understand what's being asked. And that time in an exam is probably not a good time to have to figure all that out. So I try to give you that information, but we won't be testing that type of question, okay? So those are my only two current liabilities, right? All right. Now, what about long-term liabilities? We have notes payable, right? Is that the only ones you have there? All right. And then we have equity. We have common stock and retained earnings. What if I had this thing called preferred stock? Focus on the word stock. If I had preferred stock, what would that be under? Would it be under assets, liabilities, or equity? Equity. So what we're doing is we're thinking about other things that you've probably seen, making sure you've captured all of that where you should be. And in the end, this is what we'll have in terms of our total liabilities and total liabilities and equity. I can't see that number there, but if you want to try, we'll take what we have, 11,980. Make sure you see everything, okay? Excuse me, 11,980 is what it was. And we will subtract our total current liabilities of how much?
Oh,
sorry.
I didn't write down the notes.
Oh, no, that's okay. That's okay, what we can do is, when you get home, just check and see if it equals 11,908. And if it equals, that's your answer right there. You know for a fact that you have it. Now, that doesn't mean that you could, now sometimes, go back, oh no, all the time go back and check your work, because you could have probably accidentally put one up here, but I think you would have probably caught that, by now, in terms of whether it was a liability or equity. You could have possibly accidentally called common stock retained earnings, but at least you know you're all in the right category. So you can have the overall answer of, in this case, $11,980, right? As long as you have that equal this over here. Why does that equal? Because I have $11,980 worth of assets that I paid for either using my own funds, equity, or I bought it on credit. I financed $11,000, $11,980. I financed that using one of these two options. Okay? Does that make sense? Does that help you out? Any questions? Well, that's the hardest one you have in your exam from chapter 2. Okay? So, all we're talking about in this case is mostly being able to categorize. Remember, I told you, accounting is not about, you see all we're doing is adding and subtracting, right? Accounting is just about categorizing and make sure we have those categories down pat. Yes, ma'am?
This is more so about whenever we take the actual test. Since we're doing a lot of like adding and subtracting, are we gonna need to are we gonna be provided a calculator? Are we gonna have to bring our own calculator, or are we not allowed to have?
The testing center always provides the calculators for, and yeah, everyone here will be taking on campus, so the testing centers provide the calculator, so you don't have to worry about, matter of fact, if you did bring your own, they wouldn't let you use it, so. And it's usually a 4-function calculator, so once again, just showing that it's not difficult with that respect. It's more so about making sure we categorize things a certain way. Everybody still good?